Hey guys, if you're struggling with cash flow and affordability in today's market, stay tuned because we're about to touch on 3 popular products that fix these issues.
Hey guys, Josh and Ehren. In today's video, we want to discuss popular products in today's real estate market. We understand that the shift in today's real estate market is causing some turbulence for real estate investors. We wanted to break down a few different products that we're seeing most investors use to continue to scale or to continue to actually purchase in today's market.
Yeah, with the rates, having gone up close to 300, 400 basis points over the last, year and a bit, obviously qualifying, especially on the residential side and commercial side, it's been a lot more difficult. When we take it into consideration the stress test, a lot of guys are stress testing close to, that 8% mark, and that's on both the A side and on some of our subprime B mortgages. So we wanted to just highlight some of the products that are helping investors get in and solve some of these issues with affordability.
Yeah, so if you guys didn't know recently, in the last 2 to 3 months, we did see a decrease in the bond market. So fixed rates did go down, and we did see an alleviation of that upward pressure on buyers. Now, we are starting to see the bond market creep back up, and fixed rates are going back up, and it's starting to cause affordability issues again. So the first kind of product we want to talk about is a really great product that's been in the market for a long time, but this lender specifically is a mortgage investment corporation. This lender specifically focuses on helping investors and consumers purchase and refinance in turbulent times. All right, let's dive into the actual product itself. So this lender is offering a 699-2 product. For anybody who doesn't understand what that means, currently right now B lenders are offering roughly this pricing in the conventional markets, essentially meaning if you went to an alternative lender and you wanted to qualify for this loan, you would have to go and do all the income verification required to be able to service this debt. Well, this mortgage investment corporation allows for a little bit higher debt servicing ratios, longer amortizations, and in some instances even no doc income verification for people who maybe don't necessarily have the most conventional ways of showing their income, such as cash jobs or maybe bruised credit. Now, the important thing we want to discuss today is that this product is undercutting the market. And it's kind of a big deal because if you're a person who's having a hard time getting into, say, an investment product or investment deal, and you're having troubles being able to qualify, or you're worried about the carrying costs, this product is going to allow you to be able to push out the amortization up to 50 years and sometimes even an interest-only option, which is going to reduce the carrying costs and maybe actually allow your numbers to work for a short period of time.
Yeah, and it's important to note that we're not looking at this as a long-term solution. This isn't something that we're trying to push long-term because it is, still a private lender. But the benefits, like Josh said, when we're qualifying, we're not qualifying in the same stress test that you would be on the B side, where with the similar rates, you'd be qualifying close to 899, 88. With our MIC, we're just qualifying at the 699, so we don't have to worry about that. So not only are you getting more affordability by not having to go through the stress test, but you're also working with more capacity in your debt ratios, more aggressive underwriting on your rental programs as well too. And if you're someone who's just looking to transition, you have your own business and you're just getting into it, haven't been in business long enough to qualify with an actual bank, this is going to be the lender that's going to allow you to get into this product for a year, get your business in order, and then allow you to go back to more conventional debt and take that out into more term financing.
So for clients who are using this product, it's important to understand that they're not using it as a long-term solution, as Ehren said. What we're doing is we're looking at 12 to 24 months out to understand, are you going to be able to transition out of this product as well? Now, this isn't a long-term solution, this is a short-term option, but for people who are in situations where they do need to refinance and maybe B lending is no longer an option, this is going to allow you to really lower your carrying cost and allow you to have roughly the same payment monthly as you would normally have with your B option, at least for the next 1 to 2 years until rates start to stabilize out.
Yeah, and for the investors that, maybe we're looking at a project from a BRRRR standpoint or a flip standpoint, we know investors rely a lot on the revolving debt to do the work. If this is a situation where, you just can't get the value that you need right now to pay off all your debt, or the affordability, I guess, more so in this case, isn't there for you to refinance out, this could be another opportunity for you to refinance into, this semi-private debt, pay off your debt to, to keep your balances at zero, help your credit score stay in the appropriate range, and then again, we're looking at a 12 to 24 month time to be able to exit back out into conventional financing. Just looking for other options to help people continue to move forwards. As we know, housing prices are down right now, so it's there is going to be a really good opportunity of buying moving forwards, just compared to where prices were over the last year. So having high debt ratios, keeping those debt facilities high, that's going to impact your credit score. We're trying to just keep you in a situation that's going to allow you to move forward and keep on investing.
I think those are great points, because we're starting to see that a lot, is where investors would rather not restructure their debt and keep higher balances on their credit limits, but when the time comes to actually restructure your debt and move it into some sort of conventional financing, waiting that time frame to do so is actually shooting yourself in the foot, because it's negatively affecting your credit and is putting you in a situation where banks may not want to actually refinance or restructure your debt at that point. So there is an upfront cost to this, guys. This is a mortgage investment corporation. The product we are speaking about, they do charge 2%. Now they can add it on to the loan amount, meaning there's no capital actually out of your pocket to do this, but sometimes that 2% might be worthwhile to be able to pay, to be able to make sure you're in the financial situation required to transition and move into a better product when the time comes.
Yeah, and this is a solution product. This isn't an everyday product for everyone. So, for those of you asking why would I pay, 2% plus, whatever brokers and the legal fees are going to be, it's a solution for someone that has to be able to find a way out of the current product that they're in. You might be in a higher interest private debt. We're seeing a lot of stuff that's 12 to 15% debt. Obviously carrying that even at interest only is going to be a high monthly burden and really going to cut out any cash flow. So just finding a way to get you something into a lower debt, easier to qualify, pay off your debts, allow you to move forwards, that it's solutions based. One of the products that we wanted to talk about with you guys is on the commercial side. It's a repositioning product. So this is a true repositioning product offered by a bank, not by a private lender. So there's a few benefits that we're going to be able to have from this product versus some of the other stuff that's out there. So for those of you that are looking long term and your goal on repositioning your 5 and up unit is to go into CMHC, well, CMHC can be picky on who is lending on your first position. So who are they taking out on that refinance? If you have a no-name private or a hard money guy or some sort of just numbered company, or honestly just anyone who doesn't have that certificate of insurance capabilities with CMHC, you're going to be in the gray zone. It's going to be a coin toss as to whether or not CMHC is going to allow you to do that refinance. There are some situations where they have, and there are some situations where they've said no. So using a bank that's certified, has that certificate of insurance, that's going to allow you to have complete ease of access going into CMHC without any worries. The rates and the fees are also going to be a lot more competitive than what you're going to get if you have to just go with some sort of like hard equity lender. For us, the Findlay team, we've been doing enough business with them that we actually get a little bit of a rate premium, or I guess a rate discount, however you want to look at it. But we're taking a look at a standard deal. If you're at a loan size of around $2 million, you're going to be around prime plus 2. Anything above that $2 million loan amount, you might be sitting around prime plus 1.65, 1.7, again depending on the size of the mortgage and where the building's located. And the fees, we're working with an actual bank, so your bank fees are closer to a 1% lender fee versus some of these private guys out there that can charge up to 2.5%. So right away you're saving some money right there, and especially on these larger loan amounts, that 1% in addition adds up pretty quickly.
For sure, I love this product. I personally use this product. A lot of my clients use this product, and it's a great way to be able to actually acquire underperforming assets. And in today's market, purchasing a turnkey asset necessarily isn't the game plan that I'm seeing a lot of investors approach for multifamily property. As we've said probably for the last 12 months, there's a huge push into multifamily real estate. The numbers aren't working for residential real estate anymore, and everybody's trying to find a solution to be able to scale using commercial financing. This lender specifically focuses on allowing you to be able to use a much lower debt service coverage ratio than you would normally have. Now, you can sometimes have an under 1 debt servicing ratio. What that means is the property isn't necessarily operating at high enough level to support the debt right now, but what we're going to look at is your ability to be able to actually turn over the units or to be able to renovate the property. So if you have vacancy, most conventional lenders will not allow you to close with vacancy. If you have significant amount of renovations, some will require a larger cash holdback. back. And this lender understands that there is some capital involved in actually being able to do the project. So the beautiful thing about what they do is they allow you to, or they'll actually fund your renovation budget. Now, we've talked about this product before, but we're starting to see an immense amount of our investors use it to actually be able to get results in this market. For example, if you're looking to use a vendor take back to be able to acquire an asset, this lender allows you to do that as long as it makes sense and the numbers work. So as an investor, if you're looking for a creative way to get in and you understand that you don't want to put maybe 25% down but have a giant carrying cost and a huge loan amount and then large fees, you can actually use this lender, reduce your carrying costs, reduce your fees, and start funding your actual project to do it properly. It's important to understand that this market, we're really focusing on location and like the strength of our actual borrowers. So again, this lender is a bank lender, but you really want to determine exactly what type of asset you're going to be buying and where you're going to be buying it, because it's going to get you much further ahead in today's market.
Yeah, and something else too, if you're business for self and you're looking to get into the multifamily side or commercial side for both of these, for this product here, they'll actually take a look at your your personal T1s or your statement of business activity and try to find a way to be able to use some of that net income after tax as well too, and add that back onto the application. So if you have a business that's operating and it has a decent amount of cash flow after your expenses, they will actually allow you to incorporate some of that back onto the actual debt servicing sheet as well too, and help that asset start to qualify. So if the building itself is debt servicing at 0.75 DSCR, we want to try to get it to at least 0.9. If you have some of that healthy income in your corporation, they'll actually add that back onto the numbers, allow that to get back up to that 0.91%, and then be able to go through and complete the repositioning on the product. So these guys are really friends for the investors. They're not operating as kind of like a typical bank is. They're really out there trying to dig through the trenches and dig through the paperwork, and they're trying to find ways to be able to get you investors into your product, and they love working with you guys. So they're definitely one of the best products out there that we found. There are some of these other repositioning products on the private side, but again, you're dealing with 2 to 3% on the lender fee. Your rate's going to be a lot higher as well too. So there's a lot more benefits going with an actual bank than going with a private lender. This bank also has a private equity firm that piggybacks off of them as well too. So this is actually something that I'm doing right now for a client where the bank came to the table with a 75% loan to value offer. It just wasn't as high leverage enough for the client to make it work. So the bank took this to their private side, where the bank will bring the 75% of the loan to value, and then the private equity firm comes in and picks up the rest. So we're actually doing up to 91% loan to value right now, but there's a lot of competitive options that's going to help investors be able to succeed and get the competitive financing that they want going in through a bank.
I think it's important to understand that the strength of your borrower has a lot to do with that situation. Like, as an operator, have you done it before? Do you have the capital to do this project? What is your exit strategy? Like, specifically, they understand CMHC and their takeout financing to be able to determine, does this make sense, and can I go higher loan of value to be able to actually do it? So guys, just when you're looking at these scenarios, you're looking at these options, like understanding that you can be extremely flexible and the banks can be extremely flexible, but you still have to have the strength of a borrower to be able to do this. And that transition from residential to commercial, the great part is you don't qualify with your personal income and your personal debt servicing ratios, but you do qualify with how strong you are and how many times you've done this before and what you have behind you to actually do this. So just keep that in mind when you're looking, but there are deals happening and there are phenomenal deals happening. People are still making a ton of money in the market, and there are products out there specifically made to help you succeed in this market. All right, guys, last but not least, we're going to talk about the CMHC MLI products. Now, I know we've talked about this a few times. We have a few videos out on this specific type of financing, but today we want to talk about what we're seeing since it essentially launched, how are investors using it, and how it's maybe changed since it initially actually dropped. So for anybody who doesn't know, this is essentially a point-based system. It's based off 3 pillars: affordability, energy efficiency, and accessibility. Now, the higher the points you receive, the better financing you actually achieve. Some people choose to focus more on affordability, meaning a certain percentage of your building is going to be underperforming. Some people choose to use the energy efficiency side, and some people choose to use the accessibility side. From my personal experience, a lot of my clients are actually focusing on the energy efficiency side of qualification, just because it doesn't affect the actual value of the asset based off of the net operating income. It's actually creating a better building, and it seems to be an easier way of actually qualifying.
Yeah, and I think, one of the benefits of going that route too is you're reducing your operating expenses, at the same time. Like, again, going back to the example I was just talking about, for the client that I'm working with right now, he's going in through the energy efficiency program. He's going to have his 100 points, but he was going over the numbers and how much it was going to save him, and it was going to save him close to like $35,000 to $40,000 on his utility bill. I mean, it's a larger portfolio. It's 64 properties, but when you're taking a look at getting in through a point-based system that's going to allow you to get up to 95% loan to value with potentially a 50-year AM, much lower insurance premiums, and reduce the operating cost of the building, which is essentially just adding more cash flow to you. It's almost a no-brainer. Why would you not go with this product? Obviously you do have to have some of the costs available and some of the financing available to be able to get this done. But if you go back to the product that we just talked about, where you can get in through a repositioning loan that's going to give you up to 75% of your cost to go and get this done, again, you can finance these things. So I think the energy efficiency program is definitely the most popular right now. In terms of the affordability pillar, I have heard there are some individuals using it. I think this is more based on just on the acquisition. Maybe there isn't a way to be able to turn over the building properly, or maybe they didn't want to go private. Whatever the reason is, if your rents are low enough and it falls under the pillar, you can get into the CMHC product right off the get-go. So I can see why that might be attractive to some people. And the affordability, it's all based off of different regions. So on the affordability pillar, when we're taking a look at 30% under the median renter income, not median rents in that area, depending on which area you're in, you might actually still be getting decent enough cash flow on the building that it is worth it to you. So the affordability pillar is really going to be based off of what is the median renter income in that area, and that's available either through us or on the CMHC website if you know how to access that. Taking a look, that's actually going to allow you to plan your purchase a little bit better and figure out, okay, where would I like to buy if I'm going to go through this program. If you do go on the affordability side, it is a 10-year commitment to keep those rents under that threshold. Now you can increase the rent as the renter income in that area does start to increase, but you still do have to follow that 30% under benchmark.
Now, initially when we first had this application launch, CMHC, this was kind of new territory. Now, they had an energy efficiency side, and they repurposed their energy efficiency requirements into this product. Now, from the conversations I've had with the banks, they weren't expecting the mass amount of applications coming in from this exact product. I think a handful of reasons why. The world has crazy high interest rates right now. It's very difficult to be able to finish an actual project and move into conventional financing without leaving a lot of your capital in the deal. I think it was kind of the perfect storm of that product launching, the economy being where it's at, and then rents rising, and everybody's looking at a solution to be able to have like a longer term financing strategy. But when this product launched, there were not as, dialed in underwriting as they should have been, just due to where the application amounts are right now. So what we're seeing is there's a much stronger emphasis on overall global debt servicing ratio in your portfolio. Essentially meaning, guys, if you are moving into CMHC MLI and you have a 1.1 debt servicing ratio in your building, they want to make sure your other assets are operating at a 1.3, meaning you have a strong portfolio. What they don't want to see is you're qualifying at a 1.1 on this building to be able to stop bleeding somewhere in your portfolio. So if you have a few projects on the go, and those projects are either in the middle of renovations or they're not operating at a high enough level, just something to consider when applying to CMHC, because they are going to start to take a look at you heavier as a borrower, especially in today's environment.
Yeah, and it's like Josh said, they want to make sure that you're not just skating by, and it's something that I tell every one of my clients when I underwrite. If you're right at that threshold of either 1.1 or 1.2 or 1.15, whatever the bare limit is for these lenders, expect some pushback. You don't have any more margin in your deal for a slight increase in rates or your rent coming in slightly lighter. Whatever these issues are, you don't have that forgivability. Whereas if you're coming in at 1.3, 1.25, a fair bit above the bare minimum, then the lender's comfortable because you have some flexibility. I think one of the biggest reasons that we're really starting to see this is because these products are being used as more of an emergency exit right now, and not just as the intended target right out the gate. And when I say that, I know some people say, that is my intention, but it's only, the intention for a lot of people right now because they can't qualify any other way. Sometimes I get clients that'll ask, why would someone not go with CMHC? And in today's environment, it may seem like that it doesn't make sense. But if we go back to the start of 2022, I guess, when we were underwriting commercial at 3.7%, and not 6.7, 6.85%, and CMHC was 2% or less. Then when you have these rates that are a lot more similar, and you start taking into consideration application fees and CMHC premiums and stuff like that, at that point you can kind of see why it may or may not be worth it for some individuals to go into CMHC. But in today's market, it is more of a no-brainer. You're shaving almost 2% off of your qualifying. You're getting a much higher amortization. It does make a lot more sense. So as of right now, yeah, the CMHC I think is going to keep on tightening down. There is personal recourse and there is personal guarantees involved with all these commercial loans. I mean, they don't want to just be handing these things out. We are seeing some of the lenders that are going into CMHC starting to raise their minimum loan amounts. One of the lenders that was one of the only ones as like a major institution that was lending on CMHC under like $1 million has now raised that up to like $1.5 million or $2 million. So we're starting to see some adjustments from the lending standpoint, and I think that's just due to the environment and the amount of volume that they're getting.
Yeah, completely agree. If you have a fiveplex at like $700,000 in Timmins, you're probably not getting CMHC financing on that property. Unfortunately, from a banking perspective, it takes the same amount of time to underwrite a $10 million deal as it does a $1 million deal. So from their perspective, they're seeing a massive inflow of applications, and they're most likely not going to take on an application that has less than $1 million in loan amount. This product is a phenomenal product. As Ehren said, the resurgence of this product due to the economic climate is causing CMHC and their underwriting partners to change the way in which they're looking at applications. But if you guys have any questions about this, feel free to reach out to Ehren or myself. We do this every day, all day. We understand these products in and out, and this is starting to be a staple in people's portfolio growth, especially in markets like this where we are seeing high interest rates and we don't expect them to really come down drastically for the next few years. If you're in a situation where you're finishing a project or you are looking to maybe stabilize some cash flow on a pre-existing building, reach out to us. We're always happy to help and run some numbers. Thanks for watching today's video. If you did like this video, please hit the subscribe button, hit the like button. It allows us to create more content like this for you to be able to help you navigate today's market. If you are looking to reach out to us, our contact information is down below, Instagram, Facebook, or shoot us an email directly. We're always happy to answer any questions.